What is the condition of the global financial markets and what strategies make sense accordingly? Well, we have three financial pros to provide us with some answers. Our first guest is well acquainted with the global financial system as a former government official and as an investor. He is Peter Fisher. He is vice chairman of BlackRock and head of the firm's global fixed income portfolio management. He has served as an undersecretary of the Treasury and spent 15 years at the Federal Reserve Bank of New York. And our next guest has recently been named Morningstar's Fixed Income Manager of the Year. Along with her teammates at Loomis Sales Bond Fund, she is Kathleen Gaffney. She and her partner Dan Fuss run one of the country's best performing bond funds. It returned a remarkable 37% in 2009 after a difficult 2008 for all of us, I might add. Over the past 10 years, the fund has delivered 8.5% annualized returns. And our next guest is a third-generation value investor. He is Christopher Davis. He's co-manager of several funds managed by Davis Advisors. They include the Davis New York Venture Fund, Selected American Shares, and the Clipper Fund. And Chris was Morningstar's Domestic Equity Fund Manager of the Year in 2005. So it's great to have you all here. Thanks so much for being with us. So, Peter Fisher, I'm looking at you as you have this perch, at BlackRock, head of all global fixed income. And you and I have discussed in the past the great sucking sound that we have heard from the private sector as credit has contracted and the government has stepped in. So where are we in that process?
Well, here in the U.S., the financial sector clearly went through a painful delevering in 2008 and 2009, and the major firms are doing better. They've stabilized. Now, we are watching the painful process of lots of small banks failing. Every Friday night in America, the FDIC is shutting down some small banks. That's because there's just not enough revenues to go around. The banking sector as a whole has got to be shrinking. The big banks have stabilized. It's going to be painful for the little banks. Now, the big banks have their problems ahead, because commercial real estate is still a problem ahead of us. It moves much more slowly than residential, so the major firms are still going to have to be working out their commercial real estate difficulties. That, after all, is what really the Japanese banks choked on in the late 1990s. So that's still a challenge ahead of us, but most of them, the big financial firms, have stabilized. Now, what's next, of course, is government borrowing. Government borrowing has ballooned to try to fill the hole in demand, both here and around the world. And now in the last few weeks, we're seeing some governments run up against perhaps the limits on how much they can borrow.
So it's like a movable feast of credit crises. So as we have these rolling credit crises, what's next? You've just mentioned we've had residential real estate, we have commercial real estate, we've had the financial firms. Now we have these sovereign debts. So is there another skeleton lurking in the credit crisis closet?
Well, no, I think that's a pretty
good... Is that
enough? That's a pretty good menu. That's a pretty good list. The one thing I would say is central banks eased as far as they can go, right? So the major central banks got monetary policy as easy as it can be. There's only one way it can change from here. It can only get tighter.
All right.
So even if they haven't started, that's one of the things creeping into the markets now that's giving countries like Greece a hard time, is the next move is tighter. Even if it's just very delicate and preliminary, that's putting pressure on the periphery.
All right, and so we'll talk about that in just a minute. Kathleen, the credit markets have acted, at least last year, as if everything was back to normal.
Yes.
And I think Chris had called it the dash to trash. It had happened in stocks, and it happened in the credit markets as well. So what's your sense? Are things back to normal?
They've certainly headed in that direction. Yeah. But I think the easy money was made last year, yet with rates remaining low, we don't see the Fed hiking rates in the near term. It's important to maintain that yield advantage, look for yield. So corporates, even though spreads have tightened, do look very attractive right now. Investment grade credit, and I would say even high yield.
But the fact is, I know that you had told me earlier that in looking at the sovereign debt crisis, that Loomis Sales Bond Fund, you're actually not seeing a lot of opportunities there. Why not? Why is that a market that you don't really want to get involved in?
I think the market has been expecting some sort of a rescue, so you haven't seen yields come out to levels where it's a real opportunity for the risks, because there are some real risks with governments in that type of fiscal situation. So from a perspective of opportunity, fairly limited and not a lot of sellers right now. So we want to go where the markets are bigger, where the opportunities are better for us.
And also not enough fear in the market yet, right, in the sovereign debt area?
Not enough. We saw a lot of political situations in 2008 going into 2009. We've seen the bailouts, And I think the market has become very accustomed to that right now. So there's some complacency about taking that type of risk.
All right. Chris, you know, as I said, your phrase, the dash to trash, I mean, what is your sense of what's going on in the stock markets right now?
Well, we had an enormous recovery as we were pulled back from the abyss. And I think it's logical that people would feel we've come too far too fast. The economy, there are all these concerns that are still out there hanging over the market. People are still nervous. Well, remember John Templeton when he said, you know, bull markets are born in pessimism and grow in skepticism. You know, they mature in optimism, they die in euphoria. You know, clearly we're in the earlier stages of that. Now, I don't no idea what the market's going to do this year or next year. But what I know is we're way below where we were 10 years ago. So we keep thinking about where we were a year ago, but we forget that 10 years ago, the markets were higher, and yet earnings in those businesses have continued to grow, and a lot of world-class companies now are trading at very reasonable valuations, especially compared to some of the fixed income alternatives.
So just the fact that the markets are lower than they were 10 years ago, and you know, you've always said, you know, that you can't, you know, eat I mean, expectations or relative returns or whatever it is. But does that really mean that as a value investor that the market's cheap?
No, because it was obviously at bubble prices 10 years ago. So you're absolutely right. The old saying is the market doesn't know where it's been, right? What matters is what you pay today and what you're getting today. And right now you're buying companies, world-class companies with maybe 8% earnings yields, 3 or 4% dividend yields. It seems like, in a sense, the safer place to be. Now, when you get out to the trashier side, the higher levered, the companies that need a rebound, need a strong recovery to justify the valuations they're at now, then I would be very, very wary. But in terms of what I would call the super quality side of the equity market, it looks as cheap as it has in a decade.